Hey, what's going on guys? So today we're going to discuss MACD. Moving average convergence divergence is another trend following indicator besides RSI and moving averages that I covered before in the series. This momentum indicator consists of two lines that create buy and sell signals when crossed. The MACD also provides other useful information about an asset depending on where each line is located on the indicator window. The two major components of the indicator are the MACD line and the signal line. The MACD line is created by subtracting the 26-period exponential moving average from the 12. The signal line is the second line that is made of the 9-period exponential moving average of the MACD line. When these two lines interact, they create signals and other necessary information we can use to make good trading decisions. Similar to all previous indicators I covered so far, the MACD is considered the lagging one as well, so keep this in mind. There are three types of important data the momentum indicator provides when traders employ this particular tool in their chart analysis. First, the crossovers that can signal traders to either go long or short. Second, the indicator provides information about how strong or weak an asset's momentum is in both directions after crossover occurs. And third, the divergences that warn traders of potential reversals. Crossovers occur when the MACD line crosses the signal line in both directions, either up or down. When it crosses upward, it signals a potential reversal of the price to the upside. The bullish crossover of the MACD line is very similar to the golden cross that I covered in the previous lesson about moving averages, so this should be familiar to you if you watched the video. In this situation, traders first need to confirm that the signal is genuine by analyzing several parameters, such as whether there's a spike in volume, the presence of fresh support area nearby, and last, if there are any chart or candlestick patterns that suggest a reversal. Once they confirm that the signal is legitimate, they can initiate long positions. When the MACD line crosses below the signal line, then this suggests the downtrend reversal. This signal to sell shows the weakness of an asset and is very similar to the death cross. You should follow the same steps I mentioned earlier to verify the signal before entering short trades. This guarantees against false signals that can lead to stop-outs. Now, I'd like to emphasize here that not every buy or sell signal leads to a reversal when it comes to MACD. Sometimes an asset can go into a consolidation mode after the crossover happens. This can lead to an uncertain situation where traders usually face a big dilemma. It's whether to stay in the trade and gamble or get out to reduce the risk of a stop out. My advice would be to get out as soon as possible if there's no follow-up. If you want to know my rule of how I deal with this situation, it's pretty simple. I usually close the trade if after 6 candlesticks there's no clarity in direction. In my books, this clearly indicates there's no follow-up. Let's examine the second item on the list, which deals with the momentum of an asset. Ideally, in a bullish environment, the MACD line should stay above the signal line. This indicates strength and good momentum, which is needed for the stock to keep making new highs. The more the distance between the two lines, the stronger the momentum. With little focus, traders can visually see the distance between the lines easily, but there's a better way to do this. We need to add an additional tool to the indicator window, which is MACD's histogram. It plots green and red colored bars around the zero line. If they're above the zero line, then the bars are green and imply a bullish momentum for an asset. And if red and below zero, then bearish. By using colored bars on the histogram, traders can immediately see areas where the momentum is the strongest. These are areas where the distance between the MACD and the signal line is the furthest. The strong momentum not only helps traders initiate directional trades, but also gives them the ability to stay in a trade for the duration of a trend. This is a big deal because initiating trades is the easiest part, but when it comes to exiting, this is where most traders struggle. Honestly, this was the hardest part for me in the beginning as well. The reason is, you never know how far an asset might move in your direction. People get out of trades too early and as a consequence kill their chance of hitting home runs. By using the MACD indicator, people can deal with this issue in a simple and straightforward way. In a bullish trade setup, for example, traders can keep their positions open as long as the histogram shows the green candles and get out once the bars dip below the zero line. This works especially well on longer timeframe charts such as on daily and weekly ones. The procedure is exactly the same for short traders who would like to make the most money in a downtrend. just stay in the trade until the histogram starts creating green bars. A very simple and efficient method, right? Now let's discuss the divergences. This third item on the list deals with situations when there's a discrepancy between what the price of an asset shows and what the indicator signals to traders. For example, when the price of an asset suggests that it will keep going higher, we can make an assumption that the indicator will also signal us to buy or at least add to a bullish position. However, divergence occurs when this is not the case. The price might tell us to buy when the indicator starts showing weakness. When this happens, it acts as a warning sign that the uptrend is potentially broken and maybe it's a good idea to start paying attention to your position. In many cases, divergences lead to reversals. In an uptrend, negative divergence leads to downtrend reversals, especially during the final stages of a rally. Take a look at an example of a negative divergence observed on the daily chart of SPY. There's a clear disconnect between the price and the MACD. Price is showing bullishness while the indicator is signaling weakness. As you can see, not long after the signal was given, the price started to correct, and we saw a healthy pullback. Also take a notice of what happened to the histogram. It began showing us the red bars below the zero line right when the divergence started forming. As you can see, the histogram makes it much easier for us to spot these discrepancies. Conversely, positive divergence occurs when an asset is in a downtrend but the indicator begins to rise. This type of divergence is clearly visible on the daily chart of QQQ. The price of the stock keeps making new lows when the MACD is showing strength and starts rising. Although the histogram sends us some conflicting messages in this particular case, both the MACD and the signal lines clearly demonstrate that discrepancy. As predicted, this led to a price reversal to the upside. MACD is not the only indicator that can show divergence. The RSI that I covered in the first video in the series is also capable of showing us this. Take a look at the following two examples where we can observe positive and negative divergences as well. An ability to spot both types of divergences can give traders a powerful tool to make predictions about prices. Knowing in advance about price reversals gives an edge to any trader who is willing to incorporate MACD into their chart analysis. Although this is a very exciting tool for price prediction, it does not always work 100% of the time, depending on the market condition. For example, in a major uptrend, the chance of negative divergence producing a big drop in price is somewhat slim. However, positive divergence can give people an excellent opportunity to join the uptrend on a pullback. Conversely, if there's a major downtrend, then using the negative divergence will produce better results because in order to join the downtrend, you need to short the stock. Therefore, it's highly situational. You just need to know exactly when and which type of divergence to use in a specific market condition. I hope you guys now learned how to use the MACD indicator in your chart analysis. Obviously, with all the indicator types available out there, it can quickly become very confusing and complicated. However, if you can learn and practice using each indicator one at a time, I'm pretty sure you will eventually master them all. So in the next video in the series, I will teach you guys about the stochastic oscillator, which is another popular indicator that is used by traders. But until then, thank you guys for watching and as usual, have the green trading days. Cheers guys!